A lot of states impose an inheritance tax, and Pennsylvania is one of them. The inheritance tax is a tax that is imposed on beneficiaries on their right to inherit certain property from a person who died. The inheritance tax is also imposed on both residents and non-residents. So if you live in New Jersey or New York or Florida, but you own property in Pennsylvania, it does not matter that you are not a resident of the state. As long as you died owning something here within the state, that property will be taxed upon the person who you bequeathed it to in your will. The Pennsylvania tax rates are set forth by statute. Not everyone will have to pay an inheritance tax. For example, surviving spouses of decedents do not pay an inheritance tax, as well as children who are under the age of 21. Parents and children of decedents who are 21 years of age at the time of their death are also exempt from the inheritance tax. For siblings of a decedent, they are taxed at 12%. For children who are over the age of 21 years at the time of their parents' death, they are taxed at 4.5%. Certain assets are excluded from the inheritance tax, and those include life insurance proceeds. There are also various different exceptions for other assets, such as family-owned businesses. A qualified family business must meet various different requirements as set forth by the Pennsylvania statute in order to qualify as a family business. For example, you must have a certain number of employees, and the business must be run solely by family members. So the family member cannot be just a partial owner of the business, but they must be someone who actively participates in running the business. Certain benefits are also exempt from the inheritance tax. For example, Social Security, veterans' disability benefits, or even charitable gifts that you may make are also exempt from the inheritance tax. Once your taxable assets are identified, they must be valued for the inheritance tax purpose. And the valuation method is based on the value of that asset at the time of the decedent's death. For the most part, this is easily obtained through date of death letters, such as bank accounts or requests that various institutions can provide to your estate planning attorney or your probate attorney, who will obtain the various date of death values. Bank accounts, 401ks, and other various accounts can be easily valued at the time of your death. However, other assets such as real estate must be valued in various other different methods. For real estate, the sales price of the property, if it is being sold, may be used as the valuation if the real estate is sold within 15 months of the decedent's date of death. If the property is not sold within 15 months of the decedent's date of death, a retroactive appraisal may be sought in order to evaluate how much the property was worth at the time of that person's death. Further, if the property is not sold within that time period, any gains from the increase in the value from the date of the person's death to the sale price at the time of the sale of the property may be taxable gain on someone's personal income taxes as well. Alternatively, if the property is not sold or no sale is being sought of any real estate that is owned by a decedent at the time of their death, Pennsylvania also sets forth the common level ratio, which is another method of valuing the real estate. And this is set forth by various fractional numerical standards that Pennsylvania set out for each county, and it can be used by multiplying the assessment values of the property. To further understand how to use these valuation methods or what part of your estate will be taxable at the time of your death, contact someone who can help you, preferably from the Gross-McGinley team, to help you draft your will and understand the inheritance tax that your estate will be liable for.